Ladies and gentlemen, good evening. Welcome to the 354th meeting of the Economic Club of New York. One of the best attended meetings in the history of the Economic Club. And were I not a central banker, I would say that that indicates that those people who think that it is the era of central bankers might just be right. We are particularly happy this evening to be able to welcome our particularly distinguished guest, who has, among the many victory items on his curriculum vitae, that he is a former vice chairman of the Economic Club of New York under Dwayne Andreas, who was then the chairman of the club. But at the moment in which we live, in which the world is, as Dickens would have said, the best of worlds and the worst of worlds, the best of times and the worst of times, the United States of America and the world are particularly fortunate to have as the head of the world's most important central bank, the Federal Reserve, a man who is distinguished by the utmost integrity, great experience, and a record of achievement that is unmatched anywhere. Ladies and gentlemen, welcome back to the Economic Club of New York, Dr. Alan Greenspan.
The Federal Open Market Committee, I feel that I have the ability and the authority to say that Bill is incorrect, but tonight I just feel unable to make that statement. In all seriousness, everyone, it's a real pleasure being back here and seeing a lot of friends whom I haven't seen for months, few for years, and 2 or 3 for decades. And it's extraordinary in that the Economic Club of New York goes on from generation to generation, and somehow it holds together as the premier vehicle for those of us who want to pontificate on something usually not terribly important. I trust, however, that this evening the general topic which I'm going to explore, which is the international financial system, and which used to be a real sleeper operation years past, is all of a sudden come on the scene as one of the new elements in the international society. And there's something really quite unusual going on, and Bill and I and others and many of our colleagues around the world have been endeavoring for a number of years to see if we can get a full understanding of this process. And I must say I didn't expect, as I will point out in my prepared remarks, that we would be getting the type of crisis which we're now confronted with, which as a sidebar is going to really communicate a great deal to us about how the world works. The dramatic advances in the global financial system have obviously enabled us to materially improve the efficiency of the flows of capital and payments. Those advances, however, have also enhanced the ability of the system to rapidly transmit problems in one part of the globe to another. The events of recent weeks have underscored this latter process. And the lessons we are learning from these experiences hopefully can be applied to better the workings of the international financial system, a system that has done so much to foster gains in living standards worldwide. The current crisis is likely to accelerate the dismantling in many Asian countries of the remnants of a system with large elements of government-directed investment in which finance played a key role in carrying out the state's objectives. Such a system inevitably has led to the investment excesses and errors to which all similar endeavors seem prone. Government-directed production, financed with directed bank loans, cannot readily adjust to the continuously changing patterns of market demand for domestically consumed goods or exports. Gluts and shortages are inevitable. The accelerated opening up in recent years of product and financial markets worldwide offers enormous benefits to all nations over the long. However, it has also exposed more quickly and harshly the underlying rigidities of economic systems in which governments or governments working with large industrial groups exercise substantial influence over resource allocation. Such systems can produce vigorous growth for a time when the gap between indigenous applied technologies and world standards is large, such as in the Soviet Union in the 1960s and 1970s, and Southeast Asia in the 1980s and 1990s. But as the gap narrows, the ability of these systems to handle their increasingly sophisticated economies declines markedly. In Western developed economies, in contrast, market forces have been allowed much freer rein to dictate production schedules. Rapid responses by businesses to changes in free market prices have muted much of the tendency for unsold goods to back up or unmet needs to produce shortages. Recent improvements in technology have significantly compressed business response times and enhanced the effectiveness of the market mechanism. Most Asian policymakers, while justly proud of the enormous success of their economies in recent decades, nonetheless have been moving of late toward these more open and flexible economies of the West. Belatedly, perhaps, they have perceived the problems to which their systems are prone and recognize the unforgiving nature of the new global market forces. Doubtless, the current crisis will hasten that trend. While the adjustments may be difficult for a time, these crises will pass. Stronger individual economies and a more robust and efficient international economic and financial system will surely emerge in their wake. While each of the Asian economies is unique in many important respects, the sources of their spectacular growth in recent years, in some cases decades, and the problems that have emerged are relevant to a greater or lesser extent to nearly all of them. Following the early post-World War II period, policies generally fostered low levels of inflation and high rates of savings and investment, including investment in human capital through education, contributed to a sustained period of rapid growth. In some cases, this started in the 1960s and 70s, but by the 1980s, most economies in the region were expanding vigorously. Foreign net capital inflows grew, but until recently were relatively modest. The World Bank estimates that net inflows of long-term debt, foreign direct investment, and equity purchases to the Asia-Pacific region were only about $25 billion in 1990, but exploded to more than $110 billion by 1996. Less comprehensive data suggest that inflows rose to a still higher rate earlier this year. Sustained spectacular growth in Asian economies fostered expectations of high returns with moderate risk. Moreover, the global stock market boom of the 1990s provided the impetus to seek these perceived high returns. As that boom progressed, investors in many industrial countries found themselves more heavily concentrated in the recently higher valued securities of companies in the developed world, whose rates of return in many instances had reached levels perceived as uncompetitive with the earnings potential in emerging economies, especially in Asia. The resultant diversification induced a sharp increase in capital flows into those economies. To a large extent, they came from investors in the United States and Western Europe. A substantial amount came from Japan as well, owing more to a search for higher yields than to rising stock prices and capital gains in that country. The rising yen through mid-1995 also encouraged a substantial increase in direct investment outflows from Japan. In retrospect, it is clear that more investment monies flowed into these economies than could be profitably employed at a reasonable risk. It may have been inevitable in those conditions of rapid growth, ample liquidity, and an absence of sufficient profitable alternatives that much investment moved into the real estate sector with an emphasis by both the public and private sectors on conspicuous construction projects that had little economic rationale. These real estate assets in turn ended up as collateral for a significant proportion of the assets of domestic financial systems. In many instances, those financial systems were already less than robust, beset with problems of poor lending standards, weak supervisory regimes, and inadequate capital. At the same time, rising business leverage added to financial fragility. Businesses were borrowing to maintain high rates of return on equity, and weak financial systems were poorly disciplining this process. In addition, explicit government guarantees of debt, or more often the presumption of such guarantees by the investment community, encouraged insufficient vigilance by lenders and hence still greater leverage. But high debt burdens allow little tolerance for rising interest rates or slowdowns in economic growth, as recent events have demonstrated. Moreover, the rapidly growing foreign currency denominated debt, in part the result of pegged exchange rates to the dollar, put pressure on companies to earn foreign exchange. But earning it became increasingly difficult. The substantial rise in the value of the dollar since mid-1995, especially relative to the yen, made exports of the Southeast Asian economies less competitive. In addition, in some cases, the glut of semiconductors in 1996 and the accelerated drop in their prices suppressed export earnings growth, exerting further pressures on highly leveraged businesses. In time, the pressures of what had become fixed exchange rate regimes mounted as investors, confronted with ever fewer profitable prospects, slowed the pace of new capital inflows. Fearing devaluation, many domestic Asian businesses sought increasingly to convert domestic currencies into foreign currencies, or equivalently, slowed the conversion of export earnings into domestic currencies. To counter pressures on exchange rates, countries raised interest rates. For fixed exchange rate, highly leveraged economies, it was only a matter of time before slower growth and higher interest rates led to difficulties for borrowers, especially those with fixed obligations. Particularly troublesome over the past several months has been the so-called contagion effect of weakness in one economy spreading to others as investors perceive, rightly or wrongly, similar vulnerabilities. This is an age-old phenomenon. When investors are unsettled by uncertainties and fears, they withdraw commitments on a broad front. The finer distinctions between countries and currencies are lost. There is a flight to safe haven investments, many of which are in developed nations. Perhaps given the circumstances, it was inevitable that the impressive and rapid growth experienced by the economies in the Asian region would encounter a temporary slowdown or pause. I say temporary because there is no reason that above average growth in countries that are still in a position to gain from catching up with the prevailing technology cannot persist for a very long time, provided their markets are opened to the full force of competition. Nonetheless, free market, even partially free market economies do periodically run into difficulties because investment mistakes invariably occur. And as I noted earlier, many of these mistakes arose from government-directed or influenced investments. When this happens, private capital flows may temporarily turn adverse. In these circumstances, individual companies should be allowed to default, private investors should take their losses, and government policies should be directed toward laying the macroeconomic and structural foundations for renewed expansion. New growth opportunities must be allowed to emerge. Although the economies of the troubled Asian countries were usually characterized by a combination of current account deficits, large net foreign currency exposures, and constraints on exchange rate fluctuations, one cannot generalize that these are always signs of impending difficulties. Large current account deficits per se are not dangerous if they result from direct investment inflows that are not subject to rapid withdrawal and that generate an increase in income sufficient to compensate the investors. Foreign currency exposures need not be a problem if positions are properly managed and the risks are recognized. Fixed exchange rates also are not necessarily a problem. Indeed, if they can be sustained, they yield extensive benefits in lower risk and lower costs for all international transactions. But a small, open economy can maintain an exchange rate fixed to a hard currency only under certain conditions. Both Austria and the Netherlands, for example, have been able to lock their currencies against the Deutsche Mark because their economies are tightly linked through trade with Germany. They mirror the Bundesbank's monetary policies, and they are perceived to engage in prudent fiscal policies. Were it not for issues of national identity and seigniorage, they could just as readily embrace the Deutsche Mark as their domestic currency without any economic disruption. Other economies, such as Argentina and Hong Kong, have fixed their exchange rates essentially through currency boards. But when exchange rates are fixed with or without currency boards, should monetary and fiscal policies diverge significantly from those of the larger economy, the currency lock of the smaller economy would be difficult to hold, irrespective of the size of reserves. Large reserves can delay adjustment. They cannot prevent it if policies are inconsistent or prices in the smaller country are inflexible. A well-functioning international financial system will seek out anomalies in policy alignments and exchange rates and set them right. In such a system, the exploitation of above-normal profit opportunities, that is arbitrage, will force prices to change until expected returns have been equalized. To policymakers in the country whose currency is not appropriately aligned, capital outflows are too often seen as a tax by marauding currency speculators. There have no doubt been some such attempts on occasion, but speculators rarely succeed in dislodging an exchange rate that is firmly rooted in compatible policies and cost structures. More often, speculation forces currencies through arbitrage into a closer alignment with underlying market values to the benefit of the international economic and financial system as a whole. We used to describe capital flight as hot money, but we soon recognized that it was not the money that was hot, but the place it was running from. The prodigious expansion of cross-border financial transactions in recent years has tightened and refined the arbitrage process significantly. But to repeat, the inestimable advantages that it brings to trade and standards of living also carry a price. The inevitable investment mistakes and government policy failures are more rapidly transmitted to other markets by this process than was the case, say, 20 or even 10 years ago. Moreover, there is little evidence to suggest that the rate of increase of financial transactions will slow materially in the years immediately ahead. Technology will continue to reduce the costs of finding and exploiting perceived differences in risk-adjusted rates of return around the world, helping to direct capital even more to its most efficient use. Already covered rates of return on actively traded interest rate instruments have been equalized among many industrial countries. But the broader merging of world savings and investment markets clearly has not been achieved, largely because investors are fearful of investing in countries they do not understand to the extent that they do their own, or are uninformed of the opportunities. One measure of this so-called home bias in world investments is the degree that portfolios remain substantially local. Foreign investments on average represent less than 10% of U.S. portfolios, for example. The percentage of Japanese portfolios is only slightly higher, and 15% of German portfolios is in foreign assets. The partial exception is Great Britain, where, with a longer history of global financial involvement, 1/3 of portfolios is invested in foreign assets. Home bias in investments is considerably less than it was 10 years ago, but we are still far from full globalization. Unless government restrictions inhibit the expansion of ever more sophisticated financial products that enable savers in one part of the world to reduce risk by investing in another, the bias will continue to diminish, and the size of the international financial system will continue to expand at a significant pace. It is this overall diversification and hence lowering of risk that an effective international financial system offers. It facilitates the ever more efficient functioning of the global economic system and hence is a major contributor to rising standards of living worldwide. Nonetheless, there are those who ask whether the price of so sophisticated a financial system is too high. Would it not be better to slow it down a bit and perhaps achieve a system somewhat more forgiving of mistakes, even recognizing that such a slowing may entail some shortfall in long-term economic growth? Even if we could implement such a trade-off with only minor disruption, should we try? For centuries, groups in our societies have railed against, endeavored on occasion to destroy new inventions. Fortunately for us, the Luddites and their ilk failed, and recent generations have enjoyed the fruits of those technologies. Moreover, such a slowdown may not even be possible, at least without major disruption in cost. Newer technologies, especially advanced telecommunications, make it exceptionally difficult for open markets with associated opportunities to be suppressed. Price and capital controls, which might have been feasible a half-century ago, would be very difficult to implement in today's more technologically advanced environment. Tinkering at the edges of our system in order to produce a less frenetic pace of change would be easily circumvented. Arguably, it would take massive government controls to substantially slow the advance toward greater efficiency of our systems. This would surely produce a far more negative impact on economic growth than would be acceptable to even the most ardent advocates of reining in the rapid expansion of our international financial system. If, as I suspect, it turns out that after due deliberation and analysis, that slowing the pace of financial modernization is not in fact seen as a feasible alternative, what policy alternatives confront the international financial community to contain the periodic disruptions that are bound to occur in any free market economy? A financial system, like all structures, is as strong as its weakest link. As the international financial system has become even more complex, the particular areas of weakness to be addressed have changed. At the risk of oversimplification, let's examine some of the key links of our current infrastructure. Today, the organized exchanges and over-the-counter markets of industrial countries can handle massive volumes of transactions. Even in emerging countries, exchanges are developing and expanding. In contrast, during the worldwide stock market crash of October 1987, the transaction systems were under severe stress, and indeed some broke down, incapable of handling the enlarged volumes. As I recall, at that time, the Hong Kong Stock Exchange could not open for several days. The New York Stock Exchange was straining badly under the near 400 million daily share volume of late October 1987, with long reporting delays creating uncertainties that doubtless exaggerated the price declines. Those weaker links have since been strengthened by large infrastructure investments. Almost 1.2 billion shares traded on the New York Stock Exchange on October the 28th of this year, 3 times the 1987 volumes, with no evident problems or delays. Our equity, debt, and foreign exchange trading systems and their peripheral futures and options markets have functioned well under stress recently. These systems are not weak links in the developed economies, nor for the most part are they in other economies. Neither is the payment system, that complex network which transfers funds and securities in huge and growing volumes domestically and internationally rapidly and efficiently. The private and public sectors across the globe have endeavored diligently for years to expand the capacity of the system to meet the increasing demands put upon it. And they have initiated and strengthened procedures for reducing risk in settling transactions and diminishing uncertainties. That they have generally succeeded is evident from the smoothness with which huge volumes of funds produced under recent stressed market conditions were transferred and settled with finality through various netting and clearing arrangements. Banks are another matter. These are highly leveraged institutions financed in part by interbank credits and hence prone to crises of confidence that can quickly spread. In most developed nations, banking systems appear reasonably solid. Japan has been somewhat of an exception, but there have been some positive signs there as well. Banks have been recognizing losses, and the government seems finally to be appropriately addressing their problems. In a large number of emerging nations, as I indicated previously, banks are truly in poor shape. Lax lending has created a high incidence of non-performing loans supported by inadequate capital, leaving banks vulnerable to declines in collateral values and non-performance by borrowers. How can such deficient institutions be elevated to a level that would allow their economies to function effectively in our increasingly sophisticated international financial system? Certainly improved cost and risk management and elimination of poor lending practices are a good start. But these cannot be accomplished overnight. Loan officers with experience judging credit and market risks are in very short supply in emerging economies. Training will require time. The same difficulties confront bank supervision and regulation. Important efforts in this area have been underway for several years through the auspices of the Bank for International Settlements, the International Monetary Fund, and the World Bank. But again, it will take time to develop adequate systems and train personnel. Moreover, robust banking and financial systems require firmly enforced laws of contract and transparent, market-oriented systems of corporate reporting and governance. The current crisis in Asia is, to a much greater extent than in many previous crises, one of private, not public debts, at least de jure. Arguably, the absence of efficient and transparent workout arrangements for troubled private borrowers makes the problems more difficult to deal with. Efficient bankruptcy arrangements reduce disruptions to economic activity that often arise when losses have to be imposed on creditors. Many developing countries do not have good workout arrangements for troubled debtors, and as a result, governments in these countries often feel compelled to bail them out rather than accept the consequences of defaults. The most troublesome aspect of many banking systems of emerging countries, to expand on the issue I raised earlier, is the widespread prevalence of loans driven by so-called industrial policy imperatives rather than market forces. What is wrong with policy that has politically driven loans? Potentially nothing if they were made to firms to finance expansions that just happen to coincide with a rise in consumer or business or overseas demand for their newly produced products. In these circumstances, the loan proceeds would have been profitably employed and the loan repaid at maturity with interest. Unfortunately, this is often not the case. Policy loans, in too many instances, foster misuse of resources, unprofitable expansions, losses, and eventually loan defaults. In many cases, of course, these loans regrettably end up being guaranteed by governments. If denominated in local currency, they can be financed with the printing press, though with consequent risk of significant inflation. Too often, however, they are foreign currency denominated, where governments face greater constraints on access to credit. Restructuring of financial systems, while indispensable, cannot be implemented quickly. Yes, the potential risks to the banking systems of many Asian countries and the potential contagion effects for their neighbors and other trading partners should have been spotted earlier and addressed. But flaws seen clearly in retrospect are never so evident at the time. Moreover, there is significant bias in political systems of all varieties to substitute hope, read wishful thinking, for possibly difficult preemptive policy moves, both with respect to financial systems and economic policy. There is often denial and delay in instituting proper adjustments. Recent propensities to obscure the need for change have been evidenced by unreported declines in reserves, issuance by government of equivalents to foreign currency obligations, or unreported large new forward short positions against foreign currencies. It is very difficult for political leaders to incur what they perceive as large immediate political costs to contain problems they see only as prospective. Reality eventually replaces hope, and the cost of the delay is a more abrupt and disruptive adjustment than would have been required if action had been more preemptive. Increased transparency for businesses and governments is a key ingredient in fostering more discipline on private transactors and on government policymakers. Increased transparency can counter political bias in part by exposing for all to see the risks of current policies to stability as they develop. Under such circumstances, failure to act would also be perceived as having political costs. We should strongly stress to the newer members of the international financial community, the emerging economies, that they should accelerate the restructuring of their financial systems in their own interests. But having delayed timely restructuring, many now find themselves with major shortfalls in bank liquidity and equity capital that put their systems at severe risk of collapse before any restructuring is feasible. The IMF, the World Bank, and their major shareholders, the developed countries, may wish to facilitate adjustment through temporary loans to governments and the encouragement of private equity infusions to these banking systems. Since any severe breakdown can have contagion effects on a worldwide basis, it is in our interest to do so. These loans must be judged in their entirety. They transform short-term obligations into medium-term loans, but they do so contingent on the country using the time to reform financial systems as well as adopt sound economic policies. Such conditionality accelerates the adjustments in financial systems needed to lay the foundation for resumption of robust, sustainable growth, while cushioning to some degree the economic effects of the immediate crisis. Assistance without further reform of financial systems and economic policies would be worse than useless, since it would foster expectations of being perpetually bailed out. That in turn can induce perverse behavior on the part of emerging nations' governments and of private sector investors in emerging nations, believing that the international financial community will support these economies in part by backstopping the obligations they incur, induces investors to commit more than they would otherwise. This has tended in the past to push the expansion of investment beyond prudence, given the limit of profitable opportunities. As the international financial system becomes ever larger and more efficient, the size of the financial response, whether to help banks or to add to foreign currency reserves, may have to be correspondingly larger per unit of crisis, if I may put it that way, unless we alter our approach. While it is precarious to generalize from one observation, it is likely that the Mexican financial crisis of the 1980s was broader than in 1994 and 1995, but the size of the assistance program to set things right was much larger in the latter than in the former case. The reason appears to be that the increased efficiency of the financial system created a larger negative spillover which had to be contained. Among other developments, the marked shift from bank credits in the earlier crisis to a more securitized anonymous set of liabilities made workouts far more complex. It is hence all the more essential that the weaker links in our international financial system, the banking systems of the emerging nations, be strengthened. Preventive programs should be accelerated sufficiently far in advance of the next crisis to effectively thwart or contain it. Moreover, it is incumbent on governmental policymakers to ensure that unstable economic environments do not induce or exacerbate international financial disruptions. But governments and international financial institutions should be brought on the scene only rarely. To do otherwise risks the perverse incentives I spoke of earlier. Markets should be allowed to work. Recent events in Asia have sharpened our understanding of the complexity of today's international capital flows and presumably of similar episodes that may emerge in the future. The rapid integration of national financial systems has fostered the growth of trade and standards of living worldwide. It has also forced a review of the soundness and viability of our burgeoning financial systems. We should welcome such pressures, even as they impose challenges to all of us. The end result is very worthwhile having. Thank you very much.
Thank you very much indeed. Ladies and gentlemen, we will proceed with the custom of the Economic Club. That is, we will have questions from two club members, Mr. John M. Hennessy, who is the chairman of merchant banking of Credit Suisse First Boston and a former chairman of the Economic Club of New York, and Dr. Henry Kaufman, the president of the company which bears his name. We will begin our questions with Mr. Hennessy, and then the questioners will alternate. Mr. Chairman, you will respond to them yourself, I hope.
I will either respond or dance around in a way which hopefully nobody will notice that I did.
Your remarks focused almost exclusively on Asia, which is clearly an area of great concern to all of us in this room. But surely your conclusion that the system, this too will pass, and the system will emerge a more robust and better system, must surely be based on a couple of assumptions. One of those assumptions is that there will be sufficient IMF, World Bank, and major industrial nation resources available to these countries to be able to finance this somewhat painful and prolonged adjustment you spoke of. And I think secondly, it must be based upon a presumption that these nations will not follow beggar thy nation, beggar thy neighbor policies, and will not resort to protectionism. But I think we already begin to see calls for capital controls, certain countries taking them, increases in tariffs by Mercosur. So is there an objective basis for this optimism that this too will pass?
I think so. Let me just express some of the things which I've learned over the years in having to be involved fairly closely with a lot of these crises. The first thing I think you learn is that the amount of money that is employed by the international financial community is essentially beside the point. The reason I say that is that if you impart enough change in the underlying structure which led to the crisis, the market confidence level will rise enough to effectively enable, with very little amounts of money, for the debtor nation to be restored to the good graces of the international financial community, which by definition means that you don't use any of it. Mexico being an obvious, interesting case in point. I've also observed the situation in which the effective changes were quite inadequate, and the country ran through the assets available to them like a hot knife through butter. And indeed, it became terribly apparent that there is no level of reserves that one can achieve which will protect you from a fundamental imbalance with respect to the market. As I indicated in my prepared remarks, I was trying to indicate that if you have a misalignment of your currency, the amount of reserves which you have will enable you to prolong the extent of the adjustment. At the end of the day, you will come out the same place, maybe worse. So far as the questions of beggar thy neighbor and the protectionism, yes, human beings have the capacity to choose wrong when right is so obviously better. But markets have a wonderful capacity to correct that. And I have optimism over the years because I've learned to be utterly fascinated about how extraordinarily sophisticated those markets are and what they can do to put things right.
Henry?
Mr. Chairman, I'd like to take the other side a little bit of your very broad and detailed remarks. Some analysts contend that the Asian financial crisis was caused or perhaps greatly aggravated by excessive liquidity in the global financial markets, spawned in large measure by exceptionally accommodative monetary policies in Japan and in Europe. The liquidity bulge permitted too much credit to be made available to the Asian borrowers. So in your judgment, with the financial markets, as you stated, so interconnected internationally, is there such a phenomenon as global excess liquidity? And if so, whose responsibility is it to manage this total global liquidity?
The problem I have with the concept is not that there's obviously got to be a state in which there is excess liquidity. It's an issue of defining what you mean by liquidity. If you take a look at actually what happened in Asia, as I indicated in my remarks, there was a tremendous acceleration of capital inflow into the Pacific Asia area, which accelerated in recent years. And it was quite apparent, perhaps a couple of years ago, increasingly in recent months, that there was just too much money moving in, looking for profitable investments, than there were opportunities for profitable investments. The Japanese situation is a different one. In other words, what I would argue, and I think the data very interestingly closely related between the capital gains engendered in the West and the flows of capital from diversification into emerging nations. So you don't even have to allude to the Japanese flows of funds, which of course have been very substantial, to conclude that there was an excess of funds moving into the system. Now, if you want to say in that sense that there was excess liquidity, defining liquidity in terms of an inability for the market to effectively absorb what is occurring, then the answer is yes. I do not deny that if you have central banks all turn on the faucets of money supply, that you will create either significant price and product inflation with disastrous consequences, or for reasons we're never quite clear, that money diverts into financial instruments and reduces the cost of capital and significantly increases price-earnings ratios, for example, as a consequence. Either way, you end up with a distorted system and significant contraction. So I'm not terribly certain that, as you started your question, Henry, that we are on opposite sides. We may be on opposite sides as to what we appropriately view as the definition of liquidity, but if you accept mine, then I would agree with your conclusion.
Mr. Chairman, for these countries to embrace these painful policies, the leadership of the countries clearly have to agree with this. And of all of the countries' responses so far, I think you might make the analogy with that of St. Augustine, who said, "Oh Lord, let me be chaste, but not yet."
I think you'll find that as the discipline of the marketplace inexorably moves to evidence the distortions in various economies, that democratic systems, and these are to a greater or lesser extent democratic systems, tend to respond. And I grant you that there can be delays, and as a consequence there can be problems as a consequence of that. I think it only creates a delay. I don't think it affects the ultimate outcome.
Mr. Chairman, as you know, the Mexican crisis of 1994 and 1995 caused a considerable reassessment of the role of the International Monetary Fund. But no real consensus emerged. One view called it the expense, may be called the expensive view, and says that there should be a warning system established by the fund, objective indicators, and enhanced IMF surveillance. The contrary view says this is unrealistic and that the IMF should merely be a firefighter in terms of financial difficulties. Now, if the IMF couldn't have averted the Asian financial crisis, who else could have intervened, if at all, earlier to preempt that problem?
Well, that's a very good question, Henry, and I think that the reason why I spent as much time as I did on the issue of transparency is that when you have sovereign nations, they are sovereign, and there are no intermediaries, whether global financial intermediaries or individual countries, who can basically say to that country, you've got to get it right. I think that the answer to this is the question of transparency. We have been working on this since the Mexican crisis, as you are aware. The success has been slow, not zero. The Mexicans now publish vastly more data than they did when we were struggling to figure out what in the world was going on there. There are a number of initiatives which exist in various different international institutions which have carried forward from those initial discussions subsequent to the Mexican crisis. I think they've been going very slowly, and the reason they are going slowly is that they are very important. That is, people don't want to disclose what they're doing because it'll change their freedom of action. So we are grudgingly pushing inch by inch, hopefully yard by yard eventually, but progress is being made. I don't know of any other means that will successfully address the question you're raising other than transparency and a number of, there are a large number of other things that are being discussed, and I can see right now everyone's going to ask me to give a list, and the answer is I refuse to give a list. But we are very acutely aware of what I think you're pointing out is the really key problem. And the reason it's such a crucial problem is that the one thing that I found surprising about the recent crisis is not so much its nature. We were obviously concerned about the implication of a very sophisticated and rapidly changing international financial system's capability of moving mistakes very rapidly. What I found surprising is how fast we are moving and how far we have come from the Mexican crisis of 1994-95 to today. I assumed it would take somewhat longer. What this tells us is that it is incumbent upon, however one defines the international financial community, to accelerate the process of confronting the type of problem which you raise. And hopefully we will do it in a successful manner well before crisis number 3 of the so-called high-tech international financial era.
Mr. Chairman, even before the Asian crisis occurred, there was a school of thought developing in financial markets that views world deflation as the real threat, not inflation. How does the Federal Reserve assess the current balance of risks?
You may recall, Jack, that we always define our basic goal as price stability, not the elimination of inflation, because it's terribly obvious that one can create just as much economic instability and detriment to growth from real deflation as one can get from the obvious most recent experiences with inflation. Deflation is a very complex issue in that I guess I shouldn't say it's complex. It's more difficult for us because we've had so little experience with it to see the inner workings of the process. It's clear that there isn't just a simple deflation. In other words, there is product price deflation, and there at the moment, as you well know, the evidence is mixed. That is, goods prices are quite weak and declining worldwide and in the United States in many areas. service prices, which of course in the United States are the majority of the prices, while having disinflated to a certain extent, are still moving at a pace quite above where one would characterize the issue of price stability, even adjusting for the price bias, which we have discussed at great length to everyone's, I think, sort of boredom, I guess is the appropriate word. If I want to put an audience to sleep, I've got the tool. Then you've got the issue of asset price deflation. Asset price deflation is the really virulent problem that we should all be concerned about. And there, the difference between inflation and deflation intertwine, since it is exceptionally difficult to get asset deflation without first getting significant asset inflation. And the Japanese experiences of recent years clearly exhibit both sides of that equation. And as I've mentioned in many fora, we have increasingly discussed, as Bill knows, a number of these issues in increasing detail, in part because we know really much less about it than we would like to know. But to answer your immediate question, we focus on both issues. We think both are detrimental to our ultimate goal of long-term sustainable economic growth. And so we spend, I would say, significant amounts of time trying to understand both sides of that issue.
Mr. Chairman, could I ask you really to elaborate on part of that? How do you and your associates within the Federal Reserve evaluate the impact of changes in the value of financial assets on consumer and business behavior? Has the Fed done any studies that would shed some light on this difficult question, particularly since the effects may not be symmetrical for increases or decreases in asset values with the changing structure of the financial markets?
Yeah, I think you make that point in the last speech that you sent me, which I thought was...
I'm glad you read it. Thank you.
No, I think that that is the right question. I think that it's the issue to follow on from the previous answer is that the old notion that monetary policy was simply a question of endeavoring to watch some monetary aggregates and adjust the system, create stable product prices, and the rest of the system would equilibrate, was something which we hoped would persist for a far longer period than it did, and there were even those who said that the persistence, even when we thought it was working, was an illusion. What we are increasingly becoming aware of is how significant the issue of balance sheet effects are as the population becomes increasingly more affluent, and hence the interaction between consumption expenditures, for example, and asset accumulation of various types is far more complex than it was when only a very small proportion of people had the luxury of making a judgment as to how they were going to allocate between consumption and investment. The result is that the so-called wealth effect, meaning the impact of changes in household wealth, usually as a consequence of stock price or residential real estate price change, how that affects consumer behavior. And we spend a good deal of time on that. We've recently disaggregated the structure of consumption, income, and balance sheets into various different income quintiles to see how various different groups are behaving in this period when there's such a dramatic change in the ratio of net worth of households to disposable income. And indeed, as you might expect, we find that the level of so-called personal savings, which is savings excluding capital gains, has gone down materially in the upper income groups, and indeed accounts for a not insignificant part of the overall decline in personal savings which we observed. So there is no economic evaluation system. There is no detailed econometric model structure which will successfully forecast the next 6 months, 8 to 18 months, unless there's some very sensitive balance sheet variables in them. And I don't know how successful we have been to date, but we know that that is a direction which we have to move in an increasingly important way so far as our research efforts are concerned.
We have one last question from each of the questioners.
Perhaps we ought to move a little closer to home, where we see in the United States more and more institutions merging in banking and in securities. The question is, do we now have a situation where almost all of the major participants are too big to fail? And if this is true, or if it is simply perceived to be true by the participants, isn't there a moral hazard that institutions will become more reckless because they expect a government or international bailout in the event of disaster, and will make the Asian crisis look small by comparison?
Well, until you put the appendage on your question about the consequences relative to Asia, the answer is most certainly. The moral hazard question is probably the most important issue which confronts any of us who are involved either in domestic finance through central banks or international finance. People do behave differently if they don't think they're in trouble. And the types of actions one can very readily demonstrate creates a significant suboptimal use of resources in an economy to the detriment of growing standards of living. Therefore, there are no too big to fail institutions. It is true that we have to be very careful about the way an institution might get liquidated, but you have to distinguish between what happens to shareholders in these sorts of instances. And what the practice has been is to, for example, where there is deposit insurance, make certain that all depositors get paid off. And there has been a very significant struggle that's been going on about non-insured depositors, for example, and what type of so-called haircuts they get, if any, and what happens to debenture holders and equity holders. And because I think we are all of the view that you implied, namely terribly concerned about the moral hazard issue, that there is a very strong bias against too big to fail as a general proposition. We have to acknowledge the fact that there are institutions when, should they fail in a certain way, can create contagion of a very detrimental sort, and it's incumbent upon us to avoid that. But if there are institutions out there who think that they are, their equity is free of potential risk because there are central banks out there, they probably ought to get another job.
Mr. Chairman, have the financial problems of the Asian institutions, underscored by the wide movements in the value of their assets and their liabilities, changed your views about the desirability or the feasibility of marking to market on a frequent basis? In particular, do you think that a failure to mark-to-market in a timely way allows the authorities to delay taking action at an early stage that might prevent broader difficulties later on?
The question really refers to a position that I've publicly taken with respect to recent Financial Accounting Securities Board regulation relevant to banking. Let me just say first that I am strongly supportive of marking everything that is relevant to be marked to market, be marked to market. The question, I think, really emerges as to the applicability of marking to market, recognizing that accounting is for the purpose of something other than just keeping books. The basic purpose of accounting is to help one either run a business in a certain manner, or, if you're an investor, to understand how the business is run. Let me give you an extreme case where marking to market is wholly inappropriate. If you have a commercial bank whose sole activity is to make 1 year loans that are non-marketable, will be paid off only at maturity, and are financed by 1 year liabilities, I submit that to have an accounting system which, prior to the maturity of those instruments, causes them to fluctuate, adds nothing but distortion to one's knowledge of what that company is doing. And what I find of particular concern, specifically, for example, in this example of the banking industry, is that, and it applies by extension to the other issues with respect to Asian accounting, is that if I were a bank security analyst and I got to know the underlying trends of each individual bank's process of creating earnings, and then I did that, for example, by trying to smooth out the underlying forces which fluctuate even when you don't fully mark to market. If I had created a view of how to smooth it out, and then this new mark to market proposal were introduced, I'd find myself unwinding the particular accounting entries which were created by this new FASB type of edict. The analogy that is appropriate here in the international sphere is you don't want mark to market or data per se just to say you've got things. For example, gross reserves reported by central banks around the world I find virtually useless unless I know what the forward positions short of the currency are. We'd have a mark-to-market, terrific piece of information, but it is not useful because it's single-entry bookkeeping. And single-entry bookkeeping went out with the Middle Ages, literally. I think that it is crucially important that the data that are prepared by the emerging countries, indeed all members of the IMF, have a general consistency about them, that the issue not be whether they are marked to market or not, but whether they convey the types of information which are crucially important for investors in other countries to understand the underlying mechanisms that are evolving within those countries, and when problems which they should be acutely aware of begin to arise. Thank you very much, ladies and gentlemen.
Well, thank you to our two questioners. I think our questions were particularly difficult and penetrating this evening. but I think that our scholar got an A+ in answering all of them. As Senator Daniel Patrick Moynihan pointed out so succinctly and so well, the gentleman is a national treasure. The meeting is adjourned.